Companies Act Section 23, Public Offer and Private Placement. Section 23 of the Companies Act outlines the regulations and procedures governing the issuance of securities by both public and private companies. This section provides clarity on how companies can raise capital through various means while ensuring compliance with legal requirements. Below is a detailed explanation of the key provisions contained within this section. 1. Issuance of securities by a public company. A. Public offer. A public company has the ability to issue securities to the general public through a mechanism known as a public offer. This process involves the following key components. Prospectus requirement. The issuance of securities as a public offer must be executed through a prospectus. A prospectus is a formal document that provides potential investors with essential information about the company, the securities being offered, and the risks associated with the investment. It serves as a tool for transparency and disclosure, ensuring that investors are well informed before making investment decisions. Compliance with the Act. The issuance of securities through a public offer must comply with the specific provisions outlined in this part of the Companies Act. This ensures that the public offering is conducted in a legally sound manner and adheres to the standards established by the regulatory framework. B. Private placement. In addition to public offerings, a public company may also opt to issue securities through a private placement. The key points regarding private placements include: regulatory compliance. The issuance of securities through private placement must adhere to the requirements specified in Part 2 of this chapter of the Companies Act. Private placement is typically a method where securities are offered to a select group of investors rather than the general public, allowing for a more controlled and targeted approach to fundraising. C. Rights issue and bonus issue. A public company may further issue securities through rights issues or bonus issues, subject to the provisions of the Companies Act. Rights issue. This involves offering existing shareholders the opportunity to purchase additional shares in proportion to their current holdings. This method enables companies to raise additional capital while allowing shareholders to maintain their ownership stake. Bonus issue. A bonus issue involves distributing additional shares to existing shareholders without any cost, effectively rewarding them for their investment in the company. Compliance with SABI regulations. If the public company is already listed on a stock exchange or intends to become listed, it must also comply with the Securities and Exchange Board of India, SABI, Act, 1992, along with the associated rules and regulations that govern listed companies. This compliance ensures that the company meets the regulatory standards set forth for transparency and fair trading practices. 2. Issuance of securities by a private company. A. Rights issue and bonus issue. A private company can also issue securities by way of rights issues or bonus issues, following the provisions of the Companies Act. The processes are similar to those available to public companies, allowing private companies to enhance their capital structure while rewarding existing shareholders. B. Private placement. Like public companies, private companies have the option to issue securities through private placement. The key aspects include: adherence to legal provisions. The issuance of securities via private placement must be in accordance with the provisions set forth in Part 2 of this chapter of the Companies Act. This legal framework ensures that private placements are conducted transparently and in compliance with the regulatory requirements. 3. Explanation of public offer. For the purposes of this chapter, the term public offer encompasses several forms of securities offerings, which include: initial public offer, IPO. This is the first sale of securities to the public by a company. It marks the company's transition from being privately held to publicly traded, allowing it to raise significant capital while providing liquidity to its early investors. Further public offer, FPO. This refers to subsequent offerings of securities to the public after the initial public offering. Companies may opt for an FPO to raise additional funds, often to support expansion or new projects. Offer for sale. This involves the sale of securities to the public by existing shareholders, such as promoters or venture capitalists, rather than the company itself. This type of offering allows current shareholders to liquidate their investments while providing opportunities for new investors. D. Issuance through prospectus. All forms of public offers, whether they are IPOs, FPOs, or offers for sale, must be executed through the issuance of a prospectus. This requirement emphasizes the importance of transparency and provides potential investors with crucial information needed to make informed decisions.